Hi, and welcome to this week's Intentional Wealth Update with Morton Brown Family Wealth. I am Katie Brown, and I have Cody Demmel here with me today.
Good morning. How are you?
Hey, Cody. Great. How are you?
Good.
So, we kind of go all over the place with this Intentional Wealth Update, anything related to wealth. Sometimes it's money focused, sometimes it's more planning focused, sometimes it's investments, sometimes it's even just how we think about money. Today, we're going to get back to some of the basics of investing and talking about how we're returning to some more normal times, but what that means from an investing standpoint, some of the unique risks perhaps that might be popping up in this type of investing environment, but then also just some of the tried and true approaches for long-term growth and how we should be thinking about investing your money. Cody, if you want to kick us off, there is a lot of conversation about the more stable parts of the portfolio. Everything from cash, CDs, treasuries, up to short-term, mid-term, longer-term bonds. What is this fixed income landscape like right now? And what are some of the risks, pitfalls, opportunities?
Yep. So we're coming off one of the worst years for the fixed income because last year with the Fed having to raise the interest rates to fight inflation, the actual prices of bonds declined in value. But now that we are at higher interest rates because the Fed was raising the interest rates to fight the inflation, we're back to, I guess, what you can say a little bit more of a normal environment on the fixed income side, where you can actually pick up some yield, both on the shorter term, the intermediate term, and the longer term. And there's been a lot of talk recently about money markets and trying to pick up some yield there. And I know one of the things we wanted to go over today is the potential downfalls of that, just for if you're talking about using a money market and maybe shorter term or intermediate or longer term investments, there could be some better options because we're potentially looking at a reinvestment risk on the fixed income side going forward. Katie, if you just want to go over, I guess, high level of what reinvestment risk is.
Sure. And actually, I'm going to touch on reinvestment risk, but I also want to acknowledge there have been a lot of different risks that we've been talking about over the past 12 months. Last year, all the conversation was around inflation risk. And essentially, are the prices of goods and services going up faster than what you are earning on your money? So is your money keeping pace with those increases? That's kind of the inflationary risk. And then the conversation started to shift toward duration risk. That's a little bit more challenging, I think, to grasp. But essentially, duration risk is the sensitivity of your bonds to changes in interest rate movements. And so the amount of duration that you have in a bond is essentially how long it takes to get the full value out of your money that you've invested. And as rates are moving quickly, you could risk that you're not going to get that full value out. And so there may be some loss in the value through that duration risk. Now, reinvestment risk, that's and maybe this is why people don't understand bonds well. There's a lot of nuance to bonds.
Yeah.
The reinvestment risk is, all right, if I lock in a bond today for a set period of time, that's going to mature and then I'm going to have to reinvest it. And what does the environment look like on the other side when I go to reinvest it? Is it better or worse than the environment now? And I think that with the movement in bonds, reinvestment risk is starting to become a real question. I think you pulled a couple of really great charts to illustrate where we're at right now and what that might mean.
So what this chart is going over is the increase on the treasury rates from starting last year in January of 2022 till close of business on May 17th. So obviously, as we've spoke about, we've had a large increase on both the shorter term fixed income, which almost started at zero of January of 2022, and the longer duration, which is the green. In a normal interest rate environment, longer duration bonds yield more than shorter duration because you're taking on, as Katie was saying, a longer term risk. So we've seen obviously a large increase in the interest rates. That's why we've had a little bit of depreciation in the principal of the bonds last year. But now if we look at the start of 2023, we've actually seen a decrease in some of the interest rates on some of the longer term bonds, just because the bond market is potentially pricing in some interest rate cuts from the Fed either later this year or next year if we do have a slowdown in the economy.
And I think that's something to acknowledge. Last year was all about increasing those rates of return to combat that inflation and to slow down the price increases. But as we start to get to the peak of those rate increases, now the question is, are we potentially moving into a recessionary environment? Do rates stay where they're at, or will they eventually need to be cut? And when we see those longer dated bonds with the lower rates versus the shorter dated bonds, that means a lot of people are betting on eventually somewhere down the road there's going to be a rate cut. And so there's some wonderful yields out there in short-term assets. We can see that at the top of the graph here. If we're looking at 3-month, 6-month, 1-year treasuries, those are really strong yields right now. But the risk is if we lock that in, where are we going to be in 3 months, 6 months, 1 year? Because if we start to cut rates, then when rates go down, prices go up.
Oh, that's a good point. So if we look at just the 6 month or the 1 year, so 6 month is this orange box at the top. But right now you can get a 6 month T-bill and it's going to yield around 5.3%. If you are concerned about the economy and say we do go into a recession, whether it's this year, next year, and the Fed does have to cut interest rates, after this 6 months, now you potentially have to buy a new fixed income environment. And if the Fed does cut interest rates, instead of getting that 5.3%, you may only get 4%. So you may be buying at a lower interest rate going forward and potentially missing out on some price appreciation that you may see in some intermediate term or longer term bonds.
When we're looking at potential fixed income returns, but also stability in the portfolio, it's important to have a mix of a lot of different things, as we often talk about with diversification. It's really important to be positioned in some things that can give you yield, but also capture some of that price appreciation when yields move around. And I think where some of that reinvestment risk really comes up is if you are invested in things like a money market. You say, well, I can get 4% on my money market, or I can get a high percentage on a short-term CD. Well, the challenge with some of those, and think about it, a money market. So if you get 4% right now on a money market, you're picking up the yield. You don't have the price volatility. So that can be good for your short-term money if you need money at a certain time. But if you're using that as an investment, if rates cut, now your yield cuts and you didn't pick up any price appreciation. So it's almost like a double whammy if you're overfunded to cash. As we often talk about, cash is so important in having cash reserves and everything else. It plays a very important role. But once you fill the bucket of reserves, additional money there is not being as productive for you likely as it could be elsewhere.
Yep.
Let's switch gears a little bit though and talk about stocks for just a minute. And we're going to cite this article. There was an article in the Wall Street Journal. This actually goes back to last month. It was a column by Jason Zweig, and it's "Want to beat the stock market? Avoid the cost of being human."
First of all, the headline I think is fascinating to grab people's attention, but it goes into the opposite of obviously beating the stock market and making sure that you're not doing things in the shorter term or even intermediate term that's going to hurt your chances over the long haul. So they did a survey of around 8,000 mutual funds over the last 40 years compared to their benchmark. So just for an example, there's a S&P 500 mutual fund that's trying to outperform the S&P. They compared how those funds did in the shorter term and also in the longer term. In the shorter term, you could see some outperformance. I think it was around 40% of them potentially outperformed their benchmark over a year. But when you look in the longer term, only around 20% of them outperformed their benchmark.
Yeah. I think that was a good reminder. And some of the specific reasonings or rationales that they gave for the underperformance, obviously fees. That, of course, is going to reduce your performance. But the number of holdings I thought was interesting in that, like, if we're looking at the whole broad US market, there's about 4,000 companies in there. The average fund manager has about 160 companies inside of their fund. And they broke it down further to say the more concentrated you get, the greater the underperformance is going to be on average. And so you really do need a lot of companies in there. The other really interesting statistic And I'm going to read this to make sure that I don't mess this up because it kind of blew my mind. Research by Professor Bessenbinder shows that less than half of all stocks even generate positive returns during their publicly traded lifetime. We'll have to circle back to that for a deeper conversation later. That's in itself is interesting. But only 4.3% of stocks created all the net gains in the US market between 1926 and 2016. 4.3%. And
Yeah.
there's a lot of conversation about that, but I don't think that we've put it in that long of a historical context. How has that shown up recently?
Yeah, I mean, I think that's fascinating. And obviously, the leadership changes from year to year. So, if we look at last year, the NASDAQ or tech stocks underperformed. If we look at this year, those are the stocks that are carrying the market so far year to date because they have a very strong cash flow. People think they're still going to continue growing. So, there's a handful of stocks this year that are up over 30%, where the broad market still doing very well this year. It's up almost 10% year to date. But you can have those periods where just a small percentage of stocks carry the whole market. But I thought that was fascinating just looking back over, and I think it went back to like 1920. So like almost the entire career of the New York Stock Exchange at only around 4% of the stocks carried all the gains.
Yeah. I think that's a really good reminder because it feels in a lot of respects like that's more of a recent phenomenon. We talk about the FANG stocks, the Facebook, Apple, and just how there have been some really, really big drivers. But that's always been the case in history. But you're right, it can change from a year to year basis. So you can't just buy the ones that are doing well and expect that they're going to be part of that 4.3%. That's going to change all the time.
That kind of goes back to one of the other points in the article is that even though only around 20% of the actual mutual funds outperformed their benchmark, the average investor even underperformed even more because they were chasing the investments when they did well. And last year, they were probably scared, so they sold out towards the bottom where you had the bounce back this year.
What's the takeaway from that?
Keep holding your investments for the long term. Obviously, making sure you have the right risk tolerance. But again, we are in a better fixed income environment now. So if you are concerned, there's different options available now that we haven't had in a while to pick up some return.
Yeah. I think diversification, patience, that's going to help you kind of realize your long-term growth success. So thank you so much for tuning in today to this Intentional Wealth update as we talked about fixed income, investing, the stock market, how to approach that. And we hope that you found this helpful, informative. And if you have any questions or if you would like to hear different topics, new topics, please feel free to reach out. We would love to hear from you at mortonbrownfw.com. Take care.
Bye.